Welcome and good afternoon to everyone. My name is Mark Salter. I'm the Executive Director for CFA Society Minnesota, and we're glad that you've all joined us today for what should be a pretty interesting conversation about the corporate bond market. We're delighted to have Bill Zox and Doug Gimple from Diamond Hill Capital Management to lead this discussion. I am going to turn it over to their colleague Matt in just a moment, but before I do that, I have a couple of thank yous to do. Let's move to the next slide. First thank you is to our annual sponsor. We have a number of firms every year that invest their time, talent, and treasure to help make sure that we can provide professional learning opportunities like this. So we can't do it without them, and absolutely appreciate their support every year. So one more thank you, Megan. We have to thank CFA Institute specifically this year. Back when this pandemic first hit, the Institute looked around at the various societies around the world and said, you guys probably need to go online with some of your stuff. Can we provide a Zoom meetings license for you? We said, absolutely, thank you very much. So we always want to thank them for realizing what was needed and for supporting us in this manner. I'm going to quit talking right now and turn it over to our folks from Diamond Hill so that we can get things going. Thank you again for joining us, and take it away, Diamond Hill.
Perfect. Mark, thank you very much, and Megan as well. It's been great to get to know you and get to work with you on this. It's great to virtually be with you here this afternoon, and hopefully someday soon we'll be able to join you in person. But in the meantime, as Mark mentioned, my name is Matt Lehner with Diamond Hill Capital Management, and I'm fortunate to cover the upper Midwest, which includes Minneapolis, from an external perspective. And just looking through it here, I do see quite a few familiar names with us, but I thought it'd be helpful just to share a brief overview of Diamond Hill as well as the speakers before turning the call over to Doug and to Bill. So today, Diamond Hill, we're a boutique firm based in Columbus, Ohio, that was founded in 2000, really just based off of two principles. The first being complete alignment of interest with clients, and then secondly is specializing solely in intrinsic value investing. Currently, we manage close to $21 billion in assets across 13 concentrated, benchmark agnostic, capacity-aware portfolios. Unique to this group too, and I think it's worth mentioning that our CEO, Heather Brilliant, is currently serving on the board of governors at the CFA Institute, which I think really makes us uniquely tied to this audience. Regarding the speakers, they're joining us from the fixed income side of the house here. Bill Zox is a portfolio manager for both our corporate credit and high yield strategies. He's also one of the firm's earliest employees, having joined us in 2001 after several years of successfully practicing law in Columbus. Joining Bill is Douglas Gimple, who's our senior fixed income specialist, covering all four of our fixed income offerings, including the corporate credit and high yield, as well as the core and short duration portfolios. You might also recognize Doug from our podcast series, Investment Edge. Here's where he goes and moderates timely discussions with members from our investment team. So hopefully you're able to check us out on the Investment Edge podcast. He joined us in 2016 after nearly 20 years at JP Morgan, where he was a senior client portfolio manager representing their investment grade fixed income offerings in Columbus as well. So now for the next 45 minutes or so, Doug is going to be moderating the discussion with Bill, which of course is going to focus on his observations of the corporate bond market this year. And then I'll be back to close us out. And as Mark mentioned, as we go through our discussion, feel free to type in your questions into the text functions there at any time, and we'll do our best to monitor that and of course incorporate answers into the discussions. So certainly looking forward to a good discussion here today. And with that, I'm going to turn it over to Douglas.
Yep. Thank you, Matthew. Hopefully everyone can hear me and everything's working well. But thank you for having us. We appreciate the time. As Matthew said, I'm going to sit down, or I am sitting down with Bill, and we're going to go through kind of what's going on in the markets, get Bill's outlook, as well as just how we navigated and how really anyone navigated through these unprecedented times, which seems to be an overused term, but it is truly unprecedented. So today we'll talk about how we navigated through the volatility of the first 6 months of the year, the impact of the Fed and the government involvement, and then the outlook going forward. Matthew covered Bill's background. So I just wanted to give kind of a very high level overview of how we look at the markets. This isn't meant to be a commercial in any way, but I do believe that, our philosophy and process will come through as Bill is talking about, the markets and what we've seen, but it's important to understand how we look at the markets. We're very focused on bottom-up security selection approach to the market. We're not looking at, a top-down kind of philosophy where we're trying to make big macro bets. It's all about, finding good bonds at good prices for the portfolio and for our clients. So what you'll hear us talk about is, the opportunities that presented themselves, the ability to adjust very quickly. We like to say that, we're very nimble in this market. And as Matthew said, capacity constrained. And that's one of the things that allows us to be nimble in these markets and to shift as we did. And as we'll talk about with Bill today, but just wanted to kind of throw that out there and provide that base level of who we are and what we look at when we're looking at the market. And with that, and again, you'll hear more and more of it as we're talking, but with that, I will pivot to Bill. Bill, let's start, we can do kind of a 6-month review, if you will. Let's talk about things kind of pre-March 23rd. And we use that date as kind of the midpoint date or the important date from when things were January and February were kind of okay. We saw a little bit of a correction coming off the giant rally we saw in 2019. And then between, oil and then the pandemic and what happened. And then, March 23rd being when the Fed really stepped in. So I'll stop talking. I know we want to hear more from Bill, but Bill, how about talk about things leading up to the pandemic, then getting through kind of the first couple of weeks?
Sure. But first I want to turn it around and ask you a question, Mr. Gimple.
Yes, sir.
There are a lot of great things about Minneapolis, but the first thing that I think about has to do with the airport. What am I thinking about that
Dairy
I love
Queen.
about?
Dairy Queen.
Absolutely. That was not rehearsed, by the way. Is it still there? I hope the Dairy Queen is still in the Minneapolis airport because that's absolutely brilliant.
Yes.
You're a world-class city for that reason and many others. In terms of the markets, this year started off really as a continuation of 2019, which was very much about that Fed-driven rebound from the volatility in the fourth quarter of 2018, interrupted briefly by concerns about trade wars and tariffs and the like. But for the most part, 2019 was very much driven by the Fed. And what we learned about the Fed in 2018 is the Powell Fed is very quick to react to a tightening in financial conditions and relatively slow to adjust once those financial conditions loosen back up. And those have been important lessons in 2020. But February 19th is when risk assets peaked, and it was driven primarily by the realization that the virus was going to spread outside of China. And then we also had concerns about the political primaries and the election for the last couple weeks of February. And I was in New York doing PR on February 29th, that Friday. And I told some people that I thought the Fed was going to ease, maybe more than 25 basis points and maybe would not make it to the mid-March meeting, would probably act earlier. And as it turns out, the Fed cut by what I think like 150 or 200 basis points. I can't even remember before we got to that mid-March meeting and took rates down to zero. But the first couple weeks where it was really equity driven, high yield bonds held up much better than equities. And while investment grade credit spreads were widening, treasury yields came down even more. So investment grade corporate bonds continued to generate positive returns in the last 2 weeks of February. That continued until about March 6th, that Friday. And over that weekend, we had two things happen. One, most importantly, we had this Saudi Arabia, Russia oil price war at the same time that we realized that the impact of the coronavirus was going to be much more material on the economy than markets were discounting even in late February. So that Monday, March 9th, that week was a real turning point. I remember on Tuesday that week, our CEO came and just pulled me aside and said, the governor has been talking to us. There's a very real chance that we're not going to be allowed to come into the office next week. And don't tell anyone, but we'll know something definitive by the end of the week. And I felt like it was my fiduciary responsibility to tell all of the portfolio managers that I work with that that was a distinct possibility. And that was a very different environment for us. We were kind of our normal playbook. When volatility picks up, liquidity comes out of the market, we want to provide liquidity. We want to be on the other side of the trade. And we have our estimates of intrinsic value, and we are willing to provide a bid as long as that bid is below our estimate of intrinsic value for the bond. And we were doing that like we normally do. March 9th, March 10th, it sort of changed. Now we realize that this is going to be a very different environment. This is not just a spike in volatility and illiquidity. This is going to be something very material, very likely to lead to a full-blown recession. And from that point on, we were very much focused on maintaining all sources of liquidity in our funds. We manage daily liquidity, 40 Act mutual funds in the high yield market. So at that point, it was very important to us to have a diverse sources of liquidity and to maintain those sources of liquidity. So that meant we were selling bonds below our estimate of intrinsic value to make sure that we were maintaining all sources of liquidity, cash, investment grade, on the run, yield to call, high yield bonds, whatever our various buckets of liquidity were. We didn't want to work any of them down. We wanted to maintain them all. So let me pause there. That was really that period from March 9th to March 23rd. And that, of course, took everything down. I mean, the Treasury market totally seized up in that period of time. Equities are down, 20, 30%. High yield is down 20% or so. Investment grade corporates are down 15% or so over that period of time. It's really nothing was spared in that environment. So let me pause there, Doug.
Yeah. So as Matthew said, you joined the firm in 2001. You've been managing assets over that time period. So you've been through 2008. So let's talk about, just from a market standpoint, what was the feeling like, as you're looking at the financial markets crater? Was it a feeling similar to what you felt in 2008 and 2009, and how was the market functioning? I mean, could you get things done?
Yeah, the sense that I had that was very much based on what happened in 2008 and 2009 was that the government was going to step up in a big way. And that was a lesson that I learned. Of course, it was over a period of 18 or 19 months between late summer of 2007 and the spring of 2009 that the government took all these steps to figure out, and it was the Fed, it was Treasury, and it was Congress ultimately. And they took all these steps until finally they were able to settle the market down. I mean, markets work well to find an equilibrium in most environments, but when you get into this downward spiral characterized by deleveraging, forced deleveraging, uncontrolled deleveraging, massive redemptions, then markets cannot find their own equilibrium without assistance from the government. So from late February until March 23rd, I was convinced that the government, Fed, Treasury, Congress, they were going to do what it took to make sure that the markets were functioning. That doesn't tell you where the level will be when they will figure that out. It doesn't tell you which credits will be spared and which will be so far gone by that time that they're going to default anyways. But I was convinced that they would do quite a bit. And that was really much of March was we were communicating with amongst ourselves and with our clients. They haven't figured out what it's going to take yet, but they will, and they're working very hard on it. And it's shocking that it was really in about a month they did way more than they did in the 19 months between 2007 2009. In terms of getting things done, we could. I mean, in 08, 09, in the corporate bond market, and in particular the high yield market, we didn't have electronic trading. Now we do have electronic trading. That's a big part of what we do. Maybe half of our trades are on an electronic platform. And even when Wall Street backs off and the ETFs back off, or the authorized participants that hedge the ETF portfolios back off, we're able to transact with other buy-side participants. So we were extremely active in that period and could get a lot done. And the world was changing so rapidly that we did change the portfolio quite a bit over that period.
So we keep mentioning March 23rd, and I'm sure everyone on this call is well aware of what happened on March 23rd. The Fed comes out and launches a scattershot approach of basically every alphabet combination you can think of, whether it was the term asset-backed securities loan facility, which is TALF, which had been used in 08, or new inventions or iterations of primary, secondary corporate purchases, announced, but really not even implemented until 3 weeks ago. But that announcement was enough, and then followed up on April 9th by another announcement that they're going to buy ETFs and they're going to buy fallen angels. So talk about, and that led to, this historic run of investment grade issuance. So by June, we're over $1 trillion in just 6 months, which is more like an annual type of level of issuance. And has created what you have said in the past is this, generational type of opportunity to get into the investment grade space, even within a high yield strategy, because of the opportunities that were there. So maybe talk a little bit about, the market's reception of that massive issuance, and then where the opportunities were, broadly speaking, not even necessarily for our strategies, but just in general, because I know there were a lot of high yield managers that were dipping their toe into the investment grade space.
Sure. You might want to pull up the slide that shows the investment grade spreads.
Yep.
As I'm talking, but the investment grade corporate bond spread, we use the ICE Bank of America indices, was 100 basis points on February 19th. By March 23rd, it was 400 basis points. And that is a very extreme move. It got up over 600 basis points in the financial crisis, but that was probably entirely driven by financials that were in the eye of the storm. If you looked at that ex financials, my guess is it wasn't anywhere close to 400 basis points. And in the in the 2000 to 2002 timeframe, that recessionary environment, investment grade spreads peaked below 300 basis points. And then in the recession scares of 2011, 2016, they never got anywhere close to 300 basis points. So to go from 100 to 400 basis points, that caught our attention March 19th, March 20th, and then the issuance started. There was no issuance for a couple of weeks in March, and then some very high quality issuers started to come to the market at spreads that were, literally like 300-400 basis points wider than they had issued a couple months prior. And Exxon is one that I can recall was one of the very early issuers. And people ask me about it. My comment once, this is entirely about access to capital, not cost of capital. And that's a fantastic environment for the investor, of course. When the other side of the trade is not price sensitive, that's the best position to be in. So that caught our attention, and we started to invest more in investment grades secondary market. That week, you could look at Apple, Microsoft, Coca-Cola. They had long bonds that were down 30, 40 points in a week. but there was only so much you could buy on the secondary market. We tried to buy a lot of that, but that was one place where it was hard to source bonds. So the new issue market definitely helped. But our investment grade position in our high yield funds was already in the mid-teens, 13, 14%. And we took it up over 30% over the course of the next 6 weeks or so because of this investment grade opportunity where we were very confident that 400 basis point spread on the index was going to come back down to 150 basis points, maybe 100 basis points, maybe even lower over the course of the next couple of years. By the way, we're at 150 basis points now. It was really happened very quickly. But that allowed us to generate equity-like returns in investment-grade corporate bonds with much less risk. And we had to do that with duration. You had to create it by buying longer investment-grade bonds. You weren't going to do that with a 5-year and in investment-grade bond. But if you bought 30-year investment-grade bonds at deeply discounted prices or extremely wide spreads, you could generate equity-like returns. And that's how it played out. And not only were we doing that, but there are many distressed pools of capital that were waiting for financial distress that saw that opportunity and ended up putting meaningful capital to work in the investment grade market just because that's where the opportunities were at that particular time.
So when talking about, those kind of crossover trades where you're jumping into investment grade, maybe talk a little bit about what we have seen, a record pace of what are called fallen angels, which are those investment grade names that have dropped below investment grade, a record number for the short period of time, as well as quite a bit of debt in the triple B space that is kind of on the precipice of going below investment grade. How does the market, both investment grade and high yield, how do those markets react? And how did you see that happen when you saw names like Ford and Occidental and Kraft Heinz when they were pushed down into the below investment grade space?
Well, there was lots of consternation about fallen angels bonds moving from investment grade to high yield, taking down the entire high yield market. I mean, there was even consternation. This is over the last few years that could take down the entire economy. I mean, it was extreme. And we did see, we probably, I don't know, depending on who's measuring, we probably have 150 billion or so of fallen angels year to date, which is a very high number. And we could easily have, if we were having this discussion 3 months ago, I would have said, 300 or 400 billion of additional fallen angels, over the next 9 to 18 months or so would not be surprising. That number, is much lower now, but still meaningful. I mean, we could easily double, we could have another couple $100 billion of fallen angels. But two interesting things. I mean, one, the market on March 23rd, the high yield market bottomed and had a very strong recovery. The secondary market from that point on, based on the Fed support, which at that time was for investment grade corporate bonds 5 years and the ability to buy investment grade ETFs. That was enough to allow all risk assets to bottom and rebound. Then on April 9th is when the Fed extended those facilities to post March 22nd fallen angels. So that helped materially, of course, too, that now you have the government backstop to help those companies to finance if necessary, and that the government could buy high yield ETFs. So the facilities, both in the primary market and the secondary market, were extended to post March 22nd fallen angels on April 9th, and the government announced that they could buy high yield ETFs. But that was sort of a bookend of a period that was very unusual, where the ETFs did extremely well. The most liquid bonds that were in the ETFs did better than the broader high yield market. Now I'm talking about the high yield market, which is not, it's normally the reverse. I mean, normally the poorest performers are the high yield ETFs, and they do not beat their very liquid benchmarks that they are trying to track. And then the very liquid benchmark does not beat the broader market benchmark. And that was reversed dramatically over that period between March 23rd and April 9th, but has since, much of that has been corrected since that period of time.
And one of the things that you and I have talked about in the past, and we've discussed with clients and prospects, is the ETF market. So maybe talk a little bit about that. Your opinions on how that market got through. You talked about it a little bit already, but how it got through this event. And did they do their job? Did they do what they were supposed to do in this type of environment?
Yeah, they did what they were supposed to do in a sense, but it came at a cost that in some cases was very apparent, in some cases it was hidden. The apparent cost was LQD, which tracks the investment grade market. And that has done a much better job over time than the high yield ETFs. But LQD was trading at over a 5% discount to net asset value a couple of times in that mid-March period of time, and was at a 5% plus discount when the Fed announced that it could buy ETFs on March 23rd. So that's a very steep cost in a low yield environment.
Mm-hmm.
Yes, you have liquidity on that day, but you might be selling at a 5% discount to net asset value. And that was a 5% discount to a deeply depressed net asset value. On the high yield side, which is surprising to me, the discounts only got to about 1.5% discounts to net asset value. But what seemed very clear to me, being in the market day to day, is the authorized participants who make sure that the high yield, their business is to make sure that the high yield ETFs track net asset value. So if there's premiums, they'll close the gap, discounts, they'll close the gap. They really backed off of the market for those middle 2 weeks in March, yet the ETFs were not trading very far away from net asset value, which made absolutely no sense. And we've asked all of the pricing services this question, but I don't think anyone was really honest with us. It was clear to me that the pricing services were marking the bonds to the ETFs. So, normally it's supposed to be, you're supposed to track the ETFs, are they matching the cash market? You're looking to the cash market for the pricing, and then it's the job of the ETF to match the cash market. It was the opposite for that period of March. Otherwise, the discounts would have been much larger, probably much larger than even the 5% that you saw for LQD. Mm-hmm. But same thing, you had liquidity on March 23rd, but you were selling at a slight discount, 1.5% discount to net asset value, but the net asset value was extremely, extremely depressed. So it's not a good source of return for longer term investors. It's a good trading vehicle if you're just looking for very expensive exposure to the high yield market for some shorter period of time. Much better for professional investors than people looking for long-term returns.
So with the actions from the Fed on the 23rd and on April 9th, we've seen what I would call a V-shaped recovery in the corporate market. I mean, just a huge ramp back up in performance. And we've seen the spreads come down. As you mentioned, investment grade spreads at about 150. I think high yield spreads yesterday closed at 606. So, let's go to the question that we have discussed quite a bit. A lot of people view high yield as a tactical asset class. Get in at this level, get out at that level. And I know you don't subscribe to that belief, and for very good reasons. So maybe talk about those reasons as to why you believe high yield is more of a strategic asset class that an investor should have an allocation to at all times. Well, increasing and decreasing as the markets fluctuate, but something that should be a part of their portfolio.
Yeah, well, I think if you just look at the return and risk characteristics, and the one way to measure risk, of course, is volatility. I mean, we think of risk as the permanent loss of capital, but it's impossible to measure that in an objective fashion. So we do look at volatility, and so this would be Sharpe ratio. The high yield asset class over long periods of time has delivered a substantial part of the returns of the equity market with much less volatility. And maybe the best way to think of it intuitively is the drawdowns have been much lower in high yield than in equities, and the recovery is much faster. And Douglas, you might want to go. Should we go to the last slide here for a second?
Yeah, this one here. Yep.
Yes. This shows how high yield has done versus equities going into recession, and then for a number of years coming out of the recession over the last 3 recessions. And on the right, it shows what I just talked about, going down less, recovering faster. On the right, it shows you the cumulative outperformance, the high yield index compared to the S&P 500. So in the last recession, from the beginning of 08 to the end of 2012, high yield outperformed the S&P 500 by 53 percentage points. Various times in the prior recession, 49 percentage points outperformance, 33 percentage points outperformance in the prior recession. So relative to equities, late in the cycle, as you're entering recession and coming out, it has been a very compelling alternative to equities. At different parts in the cycle, it can be very compelling relative to high-grade fixed income, especially when interest rate risk starts to eat away at the returns from high-grade fixed income or core bonds. So one difficulty with people seeing this as a strategic asset class is you have to have the flexibility to look at it versus all other opportunities in financial markets, and it's going to be different at different parts of the cycle. It's going to be tough for someone who is just laser focused on fixed income to appreciate high yield in this part of the cycle, because they're going to want core bonds in their fixed income allocation. If they're looking at equities, they're going to say, wow, this is very compelling. I don't know how this is going to play out, but if we do enter into a recession and a significant bear market, high yield is going to be very compelling relative to equities. And then if you look over very long periods of time, you're generating very attractive returns historically, and I think this will continue to be the case with less volatility. From where we are today, one difference on the equity side is what's happening with the very strong balance sheets and the tech companies and the strongest companies. I mean, they are dominating the S&P 500. I just saw a great stat today that since June 8th, which we seem to have started another phase in this period starting on June 8th. But since that time, the NASDAQ 100 is up 7.4%, while the equal weighted S&P 500 is down 12%. So that is something that's very different. You aren't seeing that in the last 3 recessions, that extreme where a certain portion of the equity markets, which is not at all sensitive to debt or the cost of debt, is really standing on its own and generating fantastic returns. I mean, the businesses are great. The question is, will the businesses be able to live up to the valuations? And that's not something that I'm focused on at all in what I do. But if you compare high yield to the Russell 2000 or the S&P 500 absent the NASDAQ 100, you see the same thing, massive outperformance of high yield versus the Russell 2000. So from the equity standpoint, I think one interesting thing is for some allocators that are heavily exposed to the NASDAQ 100 kind of equities, they think about using high yield as a way to balance out that exposure. So they might not want to be overexposed to other parts of the equity market, but instead of that, say instead of small cap equities, they're more comfortable with high yield to balance out their exposure to the NASDAQ 100 kinds of stocks. And then on the other side today, core bonds, I mean, the Barclays Ag is yielding something like 1.25.
Right.
So it's definitely, if we have another material leg down in risk assets, you'll be happy to be there. It will hold up. But if you're talking about generating returns in excess of inflation over the next 5+ years, that's a very difficult starting point. So I think from today, once again, a strategic allocation to high yield is very compelling, and maybe more compelling than it was on March 23rd, even though high yield has narrowed. Spreads were close to 1,100 basis points on March 23rd. There's 600 today, but it might be more compelling relative to the alternatives than it was then.
So we've talked about the federal government. I don't want to say Federal Reserve because it's the Reserve, it's the Treasury, it's everyone you were talking about earlier. We've talked about, how active they've been in the financial markets and really creating that floor that we saw in March and April. How has this unprecedented action from the government impacted how you look at the markets in your process, or has it impacted it at all?
I mean, it's definitely a factor in valuation. I mean, everything that we do starts with price to intrinsic value. What is this bond worth?
Mm-hmm.
And what is the price in the market? Where can we buy it or sell it today? And we want to have as wide of a margin of safety in something that we own as we can. That's the way to increase our return and reduce our risk at the same time. The bigger that discount is between the price and the intrinsic value for something that we own. And then we have that Ben Graham view of Mr. Market, where we never want to be relying upon the public markets. We want to take advantage of the public markets. Mr. Market was the manic depressive business partner who sometimes his prices are wildly ebullient, sometimes they're wildly depressed, sometimes they're right on fair value, but you want to be in a position to take advantage of that, never be beholden to it. So if you're leveraged, you might have to live with that crazy price and it might put you under. So you never want to be in that position. That's sort of like the ultimate for risk management. That was our approach, but you definitely have to evaluate what the government is doing. I mean, I don't think it's a smart thing to say the government is distorting markets. These price signals are not valid. I'm going to stay away. I don't think that makes sense at all. I mean, what the government was doing was basically almost nationalizing the credit markets. Not every bit of the credit markets, but they were nationalizing the investment grade corporate bond market as for one thing, from 5 years and in. So at the height of the uncertainty on March 23rd, we wanted to be as close to that umbrella as we could be. That really reduces your downside and allows you to apply a lower discount rate and come up with a more valuable bond if you're comfortable that you're under the government umbrella. But then as these things progress every time, those opportunities don't last long at all. And then what you want to do is figure out how close to the government umbrella do we need to be, and ultimately over time, through what they call the portfolio rebalancing channel, the securities that are not under the government umbrella end up doing the best. But you just have to figure out, one, you can't be on the wrong side of the line. Being in Hertz, it doesn't matter where the government umbrella is. If you invest in Hertz on March 23rd, that was an over leveraged situation coming in that the government umbrella was never going to extend that far. And there were plenty of other examples of that, JCPenney, et cetera. So, what we did is we thought long investment grades were close enough to the umbrella initially. And then that's largely played itself out now. And our positions that were over 30% in our high yield strategies are now, much closer to where they were entering, below 15% in one and getting closer to 20% in the more defensive high yield strategy. So that's largely played out, but then I think the high yield market will still definitely benefit from what the government is doing. So that gives us comfort that 600 basis points spread in the early stages of a recession is still adequate compensation for the risks that we're taking because of that government support. And remember, the high yield market is still yielding about 6.5%, up from low fives earlier this year and below 5 at times in recent years. Whereas the investment grade market is now yielding 2.1%, which is, to my knowledge, an all-time low. So that's sort of how the portfolio rebalancing channel works. Under the umbrella, you get the benefits real quickly, but moving out the risk spectrum, as long as you're not too far out, is where you tend to benefit the most. So what we're doing now is trying to figure out, where you want to be on the risk spectrum, but bottom up, one at a time.
Yep. So Mark put out the call for questions. So I will echo that. If anyone has any questions, you can submit them in the chat room, and I will read them aloud and not use your name, unless you really want me to. But Bill, I'll put you on the spot and ask the age-old question: what are your expectations for the rest of the year? And I'm not asking for the yield on the 10-year Treasury or anything like that. And I understand that we're potentially going into another lockdown situation with the virus spreading. If we hold steady where we are, what are your expectations? And it's a loaded question. If you want to defer an answer, that's fine.
No. I mean, how I would answer is, for a long time I've been answering that question, is that I think that equities are going to drive the fixed income markets. And I'm talking about investment grade corporate bonds, high yield. I mean, the Treasury curve is largely pinned down by the Fed.
Yeah.
And if it got out of hand, the Fed would do more. So even though they're issuing trillions of treasuries that will have to be absorbed by the market, I'm not worried about the Treasury market at all. Pinned down pretty close to where it is. Risk assets, or corporate bonds, both investment grade and high yield, I thought would be driven by equities. If equities take another 20% plus leg down, that will cause spreads to widen materially. Nothing like we saw in March,
right,
but widen materially from here. But now I'm starting to question whether it's still going to be corporate bonds that lead equities. And some have suggested it's going to be hard for equities to sell off 20% if corporate bond spreads aren't going to widen materially. They might fluctuate in this range, say 550 to 700 for high yield, 150 to maybe 200 for investment grade. And equities will behave reasonably well if that's the case. In which case, I would think that it should be a fairly benign environment, not necessarily a high return environment, but a fairly benign environment where corporate bonds, both investment grade and high yield, could continue to generate returns, but based much more on coupon.
We did get a question from the audience. Bill, fallen angels have outperformed high yield bonds so far. Do you think they are more attractive, the fallen angel bonds?
Yeah, I mean, we always look at it one at a time, and for a long time we have invested in fallen angels while they were still in the investment grade index, but after dedicated investment grade investors had given up on them. And before, most of the high yield investors are so benchmark oriented that they will not take that out of benchmark exposure. So they wait until the fallen angels enter the high yield benchmark. So we look at every one while it's still investment grade, and for a long time have been happy to build a position while it's still investment grade, and they tend to perform well relative to high yield as soon as they enter the high yield market. But for the big fallen angels, we have not found that much opportunity. Like on the energy side, we don't like the fallen angels and don't have any exposure to them. We definitely own some low BBB energy bonds that could fall into the high yield market at some point, but they haven't yet. Ford is one where very challenged, but lots of liquidity and lots of government support. One that we're comfortable with, but want to be under the government umbrella or very close to the government umbrella, which means stay short and forward. But, we look at every one, but I wouldn't say that, we found any more to do there than we would normally, like on a percentage basis. But they have outperformed. Post March 22nd fallen angels have done much better than pre-March 22nd fallen angels since the bottom, but both have done well.
Mm-hmm. Great. Well, that was the question that we got. So, Matt, I know you wanted to kind of wrap things up from your side, so I'll pass it back to you. Thank you, everyone, for joining us. We really appreciate it. Hope it was informative. And Matthew, I'll pass it to you now.
Douglas, thank you. And likewise, Bill, thanks for sharing your insights and giving us a glimpse into how you view the world, how you viewed the world, and what you see here coming down the pike. To that end, too, I know we covered a heck of a lot of ground. First got to know Douglas a little bit more, that he loves the Minneapolis airport just due to Dairy Queen. So if you don't remember anything else, remember your friends at Diamond Hill, like to support local Dairy Queens at your airport. Outside of that, I know, talking about pre-March 23rd, really a continuation of what we saw in 2019, where it's a Fed-driven response, Fed-driven rebound. Also learned a little bit more about Powell and that he's very quick to act but slow to unwind. And knowing that, I think, really helped shape a lot of the opinions, a lot of the views Bill and Douglas discussed here today. I'll mention this too. I'm not sure if my contact information came across in the invite, but if you would like additional information about the strategies or about our thoughts, or if you have a question that we weren't able to answer, you're welcome to reach out to me directly at mlehner@diamond-hill.com. You can also go to our website, diamondhill.com, to find my contact information there as well, or as always on LinkedIn. We certainly appreciate the time and look forward to talking with you and hopefully partnering on putting some capital, especially at these levels. I think you could see the attractiveness and enthusiasm from the team itself. So with that, I will perhaps turn it back over to Mark, or we can go ahead and end the meeting today, or end the meeting at this time.
So this is Mark, and I will grab the mic one last time to say thank you. Thank you, Bill. Thank you, Doug. Thank you, Matt. We're looking forward to hearing if any of these prognostications actually do come true, and maybe we can do that over a blizzard at Dairy Queen in the airport. So appreciate
Man after my own heart.
Yeah, there we go.
Anytime, I'd fly there right now for a blizzard.
You are on. Just wear a mask. Okay.
Yes.
Absolutely.
All right. Thank you again, everybody. Appreciate it, and we'll have the replay available in a day or two. And look forward to more. Thanks, guys.
Thanks, everyone.
Thank you.
Thanks, Megan.